inflation stronger for longer. It leaves some of these central banks in quite a pickle, in a predicament, doesn't it?
To speak with you. Yes, you're right. I mean, the difficulty for central banks now is that they have these supply side rigidity, supply side shocks, which is inflating prices, as well as of course very strong consumption and demand growth. So it's kind of this double whammy. Is what is pushing inflation up so much higher. And I guess the risk of it lasting for longer is if the wage inflation comes through, and that's what we're most worried about.
Well, absolutely, and that would result in demand pull as well as cost push, which makes the perfect circle for having inflation there permanently. But how do they address it if we do see some of this slowdown materialize amongst the consumer in particular? Because then that is the recipe, perhaps, for the S word, stagflation.
Yeah, I think that, I mean, one parallel is to look back to 2011. That was the last time that global inflation was around the 5% handle. And that proved to be quite painful. You didn't have the wage pressures, but it was driven by commodity prices. And what ultimately happened was we saw quite a significant fall in equity returns, as well as, of course, earnings growth. So this kind of modern day kind of stagflation, I mean, we do have a benchmark to look back in the last decade, but I guess what makes things quite different today is that we have these demand and supply pressures and the wage pressures. I mean, you know, the Atlanta Fed leading indicator for wage pressures is at a decade high. So all of these things are concerning. And I think the way that we combat it is, so far, I think the Fed is doing the right things. They are communicating. They do seem to be ahead of the curve, but they may have to move a little bit faster than the market is pricing in, I think.
Let's talk about yields. We just showed the chart very briefly there. There's been a significant shift in where yields are closer to 1.5% as opposed to 2%, which some were factoring in by the end of the year, no longer the case. What is the bond market really saying here, especially about tapering?
Yeah, I think there is still some concerns about growth. I mean, not so much, I guess, in the US, but I guess there is concerns about the weakness in China and how that could spill over to Asia. So it is encouraging that we see China's policymakers coming out and doing a bit more. I think that yields could be pausing at the moment, but I still think that the slow increase is likely to continue. But of course, as we have these growth shocks, there is likely to be disruptions to that.
Tumbling yields paves the way for stocks to go higher. The question is, for how long, Robert?
Agreed. So, I mean, I think a lot of people have made the point that of course, multiples and valuations are still very high. As yields rise, those are likely to correct back slowly. I guess one of the key benefactors from that adjustment of higher yields, of course, is the financial sector. And I guess we are seeing signs of that already because their profitability is quite high. But I think so long as though the adjustment in yields is not too rapid, then share market returns can slow down gradually without overshooting to the downside.